In today's market, volatility seems to be the new normal. One day the markets are soaring, next day they're crashing, and every single headline seems to know what's coming next. The truth is that nobody can consistently predict what's going to happen in the short-term market. And this is why successful investors focus less on the forecast and more on building a system that allows them to invest consistently over the long term. Welcome back to my channel. I'm a qualified accountant and a chartered financial analyst with over 15 years of experience working in banking. And today I'm going to give you 5 practical strategies that you can apply in navigating through a volatile market and stay on track to achieve your financial goals. Strategy number 1, dollar cost averaging. Dollar cost averaging, or DCA in short, means investing a fixed amount at regular intervals regardless of what the market is doing. It's not about timing the market. Instead, it's to spread your purchases over time and reduce the risk of having invested everything at the wrong moment. Here's how to do it in practice. First, decide how often you'll want to invest. Weekly or fortnightly is a good frequency to invest in because it keeps you consistent without having to invest too frequently. Second, choose an amount that you're comfortable investing regularly. Now, this could be a percentage of your paycheck, or it could be just a fixed dollar amount. And that's it. Once you've set that, fix your schedule and keep investing regularly with the same amount at that same period. And the great thing about this strategy is that your investment goes up or down depending how the market is doing. So for example, if you invest $500 a week and the market's going up, then you buy essentially less shares. But if the market goes down the next week, you're buying more shares with the same $500 that you invest. Over time, this helps you smooth out your average purchase prices. Now, one thing to keep in mind is that more frequent investing is not necessarily a good thing. It's more about consistency. Strategy number 2, buying the dip. Buying the dip means increasing your purchases when the market has a pullback or there is a correction. The idea is simple. If quality assets become cheaper in a market correction, then you can essentially buy more assets for the same price. Remember, it's harder to tell when a stock or investment is good versus bad, but what's easy to tell is when that same stock or investment is cheaper or when it's more expensive. Now, the challenge is no one really knows when the market has bottomed out. The markets can always fall further. That's why I prefer combining this strategy with dollar cost averaging. Rather than investing a huge lump sum at a one period in time when the market is correcting, you gradually increase your purchases over time using dollar cost averaging. For example, if you normally invest 75% of your available investment cash each week, you might increase that to 100% during a market pullback to make the most out of cheaper prices. This allows you to take advantage of lower prices without entirely relying on having to time the market. Strategy number 3, investing in ETFs. Picking individual winning stocks is especially difficult in a volatile market. Even professional fund managers often struggle in consistently beating the market. Exchange-traded funds, or ETFs in short, provide instant diversification. Instead of buying a single individual company, you're buying exposure to a whole basket of companies through one single investment. For example, an ETF that tracks S&P 500 provides you exposure to many different companies with a single purchase. When combined with dollar cost averaging, ETFs allow you to consistently invest without always having to look for the next winning stock. Strategy number 4, keep buffer cash. Market opportunities can only be useful if you have the capital to take advantage of them. This is why maintaining a cash buffer is quite important during a volatile market. Now, if you don't have a cash pool to start off with, that's completely fine because you can build that up over time. One simple approach you could take is by allocating a portion of the amount that you would otherwise invest per week or per fortnight and putting it into cash instead. So as an example, if you're investing about $500 a fortnight into your portfolio, rather than investing that whole $500 into stocks, you could put 25% of that amount into cash. And what that will do is over time, you get to build a reserve. And when market opportunities do arrive, you can basically deploy it into that strategy. Strategy number 5, don't panic. Most investors don't underperform because they've chosen a wrong strategy. They underperform because they abandon their strategy at the worst possible time. The strategies we've discussed today are designed to reduce emotional decision making, but they're only effective if you do stick with them. Investing isn't a sprint, it's a long-term wealth building process. Once you've selected a strategy that suits your goals and risk tolerance, commit to it and avoid letting daily headlines dictate your decisions. Remember, volatility isn't something to fear. It's a normal part of investing. The key is to have a plan that lets you make the most of the opportunities when they do arrive. If you found this video helpful, give it a thumbs up and subscribe. Let me know in the comments which of these strategies do you already currently apply in your own portfolio. Thanks for watching, and I'll see you in the next one.